What's good? My name is Sean Slaughter, real estate agent and investor. And in today's market, for those who are having issue making money, sometimes it's not about the money that you make, but about the money that you keep. This is why today I want to talk about why you probably should become an S corporation and not an LLC or a sole proprietor, because you're giving more of your money away at the end of the year as a sole proprietor and LLC than you should be. Now today I'm not going to get into what is an LLC and what is an S corporation, but basically just understand that these entities exist so that you won't be personally liable if you get sued. Whatever the things that your LLC or your S corp owns are the things that are available to be taken from you in a lawsuit. So your house remains in your name. Everything else that remains in your personal name will not be touched. And as a real estate agent, because of the transactions that we do, we're always one sale away from being sued. So it is very important that as you, a real estate agent or just a business person conducting business, please make sure that you're not operating in your name and you're not getting your checks paid in your name. You should be getting your checks paid or direct deposited into your business account. So let's do a little bit of math. For LLCs are taxed at 15.3%. That is your FICA taxes, all right? So if you made $100,000, let's just say you made $100,000 net, then your taxes are gonna be $15,300. I think it was last year, I had to pay, or maybe the year before, I can't remember. I was an LLC, and I understood this, right? But I just didn't change my LLC to an S corp to be taxed as an S corp in time. And I'll talk about that in a minute. And I had to pay about $25,000 in taxes. One of the worst feelings that I've ever felt. And I said, never again. I said, Sean, stop being lazy. Go ahead and get your LLC taxed as an S corp. In order to get your LLC taxed as an S corp, just look it up on the internet. But basically it's filing form 2553. And it basically says, my LLC, I do not want to be taxed as an LLC, as a limited liability corporation. I want to be taxed as an S. Now, S corps are a little bit more complicated, and I always suggest whether you are an LLC or S corp, you should have an accountant. For years, I did the H&R block thing, and I did, TurboTax and stuff like that. And in the beginning, it was easy, but as you start making more and more money and rules change, your accountant just knows so many different things that are happening every single year with taxes, what you can deduct and not deduct. It makes more sense to pay a couple of $100s for your accountant to do your business taxes than for you to pay $100 for TurboTax. Just get an accountant. It'll actually save you more money. All right, now getting back to it. As an S corp, there's a couple of things that happen. As an S corp, you as the owner of the company are considered a shareholder and an employee, all right? In an LLC, you're considered a member, and those profits come straight to you and you get taxed, right? But as an S corp, you're an employee, W-2, you're a shareholder, K-1. Okay, those are the statements that show what you get. That's how it works. Let's take that same $100,000. Remember, as an LLC, you paid $15,300 in tax. As an employee, you're gonna have to pay payroll tax. So as an employee, the first thing you have to do is you have to determine a reasonable salary. Now, many people are gonna get audited and get in trouble if they make $100,000 and they pay themselves a salary of $20,000, all right? So what we're gonna do is we're gonna say a salary of $50,000. As a real estate agent, it can be all over the place, right? But we're gonna say we're gonna pay ourselves a salary of $50,000. On that $50,000, you have to pay payroll taxes, all right? I use a program called Wave. It's a free program, but there is in addition, an upgrade, a fee that you can pay for Wave to automatically submit your payroll taxes every single time you pay yourself. So I would suggest whether you're using QuickBooks or ADP or Wave, get one of these programs, and basically you're gonna pay yourself from your business account, direct deposit into your personal account, and then those programs will hold payroll taxes and pay them on your behalf. As an employee, instead of paying the 15.3%, you actually pay half of that, all right? So what does that mean? That means instead of paying the $15,300 that you have to pay as an LLC, you pay the half, your employer pays the other half. But wait a minute, Sean, I'm the employer. It's my business. Oh, my friend, a business. So, and of course, anybody that knows, as a business, you want to stack up as many business deductions as possible. So it is a business deduction that works in your favor. So ideally, all you're paying is $7,650, $50,000 in employment tax. Well, Sean, in the first scenario, as an LLC, I made $100,000. I paid the 15 grand in taxes, but at least I got $85,000 back. In this scenario, you just painted me, Sean, I'm only making $50,000. And even though I'm paying, $7,600 and change in taxes, I'm making a little bit less money. Pay yourself as an employee. Just talked about $50,000. Other $50,000 you take as a distribution. Right? Distributions, because you're a shareholder, right? Remember I told you, you're two people, an employee and a shareholder. The W-2 employee, $50,000, you pay your taxes on that. But as a shareholder, those distributions are tax-free. Now, there is a little caveat. There is a little star next to the tax-free, which talks about cost basis. I don't even want to get into that, right? Your cost basis basically means how much money that you've put into the business. And as long as your distributions don't exceed that, you don't pay taxes. If they do exceed that, let's say you put $10,000 in the business and your distribution is $11,000, you only pay taxes on the $1,000, all right? I don't even want to get into that, but nevertheless, even with that cost basis principle in there, overall, you're still paying way less taxes. So you're still making $100,000, just like the LLC, but $50,000 of it is being taxed as a employee, and the other $50,000 is not being taxed. So really, overall, you're saving $7,650 to be an S Corp with the numbers and the example that I gave. So don't give your money away to the government. Make sure your business is structured right. Make sure that you're being paid to your company, and it's not about the money you make, but it is about the money that you keep. Please be sure to like, hit that sub button, or karate chop that bell for notifications. If you love our programming, this is the House of Motivation, the place where inspiration